So nice to meet you. Thanks for having me. I'm Dean. I'm leading the Israeli office of DTCP. We are a growth equity firm with $3 billion in assets under management. And we invest in B2B enterprise software companies across Israel, Europe, and the US.
Boaz?
Hi everyone, I'm Boaz. I'm the managing director of Qualcomm Ventures in Israel and Europe. So we're a global fund, about 20 people, managing around $2 billion, 150 portfolio companies. Investing around everything relevant to Qualcomm, from AI to cyber, mobile, enterprise, and so forth. Pleasure to be here.
Hi everyone, my name is Yakir Makhlouf. I lead the operations for Porsche Ventures here in Israel. Porsche Ventures is the corporate arm of Porsche, the luxury sports car manufacturer out of Germany. In Israel, we're actually active since 2018 with a variety of investments. Specifically, we're investing in three main topics: industrial technologies, energy transition, and mobility. Anything from seed to early B. Doesn't have to be strictly tied to the strategic interest of the company, but it helps sometimes. So thanks, and great to be here, Gili.
So hi everyone, whoever hasn't heard me before lunch, you have to hear it again now if you did. My name is Gadi. I'm one of the partners in the venture arm of the Bosch Group. Bosch is a very large multinational company, the world's largest automotive tier 1 manufacturer. And the venture activity is relatively broad-based, looking at everything from obviously mobility, but also enabling technologies like data, AI, IoT, industrial automation, cyber, and so on and so forth. Usually we're an A or B round investor, but we also sometimes do seed deals, sometimes do later stage deals, and overall under management about 1.1 billion euros in management.
So just counting here, Boaz, how much is managed in your fund? 2.5. Yakir? So we have here around 6 billion under management on one panel. Write it down somewhere. Dean, let's start with you. What's the biggest difference you see between European investors and other investors, let's say Israeli ones, or Americans one as well, because I'm a startup, I need to decide where to go.
I think that culture, that's obvious, but if to go to the nuances of culture, is probably the fact that Europeans are less forgiving. So many times we see, especially in early stage, founders coming super aggressive with these hockey stick plans without actual budget and plans to back this. So if you meet an investor in Europe and after 6 months, 12 months, you're suddenly 80% behind the plan that you showed in back then, you kind of lose credibility. And probably the other thing is how you handle the dialogue. We always laugh internally at the team that in Israel, arguing is almost like a national sport. So come actually to listen, don't just hear, and make it an actual dialogue when you speak with the other side.
Okay, thank you. Yakir, tell me, in terms of what I need when I raise funding, because you pass it on to the European colleagues, do I need a business plan? Do I need a deck? Do I need in Israel, a deck would suffice. I'm in early stage, and what do I need now? A 6 years forecast, or what's going on there?
Sure. So actually, kind of maybe even this would dovetail into what Dean said before. I think first of all, of course, a deck is a must. Very much depending on what are the stage of the investors that you're going to. It really depends. If you're going to a growth stage investor, a deck is not sufficient enough. But if you're going to a pre-seed investor, for instance, we are a co-GP in a fund called APX or Heartfelt out of Germany, together with Axel Springer. A deck would suffice. Even a very early on. MVP or something like that. But when you're going towards, let's call it investors like us, usually we'd like to see a more devised plan. We'd like to see a team that is there, knows exactly what is their problem that they're aiming to solve, and that problem is validated and it exists. But in addition to that, we're actually looking to see exactly what Dean said in terms of a plan, right? It's not enough to only show the hockey stick. Today, that path to revenue is not only, doesn't only have to be, let's call it relatively quick. It needs to also be something that you can stand behind, defend, even when it's scrutinized and potentially get asked about the market trends and potential competitors, not only the big gorillas in the room, which every potential company gets asked about, but also when it comes to different trends in terms of regulation and so on. So very much be prepared with your business plan, show that you understand the problem, you validated it, and that you know exactly the ins and outs of your business when you get asked the tough questions.
Boaz, you've done deals in Europe, 2 deals, I think, 3. Thank you. So what's your take on valuations of Israeli startups versus European startups?
So in general, I would say that European valuation, well, it depends, right? AI is obviously a bit different. So if we just take it out for a minute, we'll go back to this quickly. So I would say that in general, valuation are more reasonable to what we see in Israel. I think here the ecosystem is very much polished. So you have everything from C to A to B. I mean, all the large funds are here. Some of them right now opening offices, very early stages. So the mechanism works very quickly, and therefore the valuations goes up. I think in Europe, sometimes we see some holes. So you see good companies raising the C, even the A, but sometimes starting with the B or so forth. So that on that point you can find opportunities. But we don't try to optimize the valuation. We're trying to put invest in the best companies. So in that sense, I think there are, for us at least at Qualcomm Ventures, there are specific domains which we really like, and I think Europe excels in. So things like robotics, industrial, definitely domains which are very we see very lot of strength there. If it goes to AI, then I don't think it's very different than any other place in the world. Even if with France, we talked about that, Mistral, Poolside, all the others growing very quickly, raising very quickly. So I don't think there is a huge there is some difference between that and Silicon Valley, but it's not very far. But as I said, beyond, I think there are opportunities for investors there, but you have to look much harder because of the diversity and the size of this continent.
And I spoke, Gili, about the cultural differences before, so I'll be Israel and hop in for 1 second. So just to echo what Boaz just said, I think that this is more of a factor of the vertical or the type of the solution than the actual geography. Eventually competitors look aside and see what was the valuation of other companies, and everyone try to at least beat their competitors.
So let's put cyber AI aside, and let's go deep tech for a second, because Europe is very well known for more deep tech stuff. Do you see any differences there between, will I get as an Israeli the same valuation as a Swiss deep tech startup, or?
From my experience, it's more or less the same. Okay. Maybe in Eastern Europe we'll get a relatively small discount to Western Europe, but in general I think it's very similar.
Okay. And
maybe jumping on that
sure.
question, I actually think that it's also kind of to also connect into that. There's also the question of at what point are we getting to the the product, right? In terms of can you please reiterate the question? Sorry, I lost the chain of thought. The evaluations in Israel, sorry, in deep tech. Apologies for that. So when you were going into deep tech, right, I think in the early stages we're very much looking at what's the stage of the product. When it's very much the deck stage, then again, maybe a small discount. When we're looking at later in the stages, in the transition from science and lab into the market, we're actually seeing that the growth, the move from the science difficulty to the engineering difficulty is where we see the most discount, right? Most Israeli companies have a hard time moving from that early stage to the growth stage because they're not maybe as well positioned for growth in terms of scaling up as the European startups. And if that's the case, usually that's where the majority of the discount takes place, because setting the right team for the science part of the, validating the science part of the project is one thing. But then you need to have almost a completely different set of skills to grow up and mature into the scaling part. And that's the part where European startups are today maybe easier, they have an easier time in transitioning, and the Israeli startups have maybe a more difficult time into getting into those stages, and valuations there are getting a bit cut.
Maybe I can add one more perspective. I think, generally speaking, European-based investors have a more limited tendency to look at really high valuations. So again, putting aside very hyped sectors, I think most European at least venture investors are not ones to run valuations high as you would see with top-tier US funds or US investors.
So connecting on that, Gadi, for you, so what are like the key financial metrics or KPIs that the European investor is looking at?
This is not more than the European, this is not the geographical question, this is a stage question. So when I would look at a company which is a late stage or a seed stage or an early A stage company, I would look at certain levels of risk reward and expectations on multiple and future current value to future value. And also obviously it's sector dependent. So if you look at a sector where the multiples in the industry are 20x revenues versus 2x revenues, it's a very so there's no one answer to that. It's very much sector stage dependent.
But I will say that if I have to choose two, then probably I know that ARR goes without saying, but ARR should be bulletproof. So it's always a fluid number, right? ARR is like booking. It's not a US GAAP that is very understandable. So different companies measure it in a different way. So the difference between, contracted ARR and implemented ARR should be very clear. I mean, if it is signed and it's going to be converted to implementation in weeks, then this is fine, you can claim it as ARR. But if you hold a contract for 6 months and the company was not onboarded it and is not paying for it, then it shouldn't be included. And the other thing is probably efficiency. Everything related to cash efficiency. I think that European investors are more conservative on cash and how you're managing your expenses than Israeli and US investors.
Thank you. Now, exit scenario. Okay, we work so hard, and Gadi, how do I exit in Europe?
You don't? Well,
fair.
It is, honestly, it's a much more challenging exit environment. I think, generally speaking, even if you look at the behavior of the M&A distribution of Israeli companies, there's much fewer companies going into European hands. So I think European companies are more valuation sensitive. They don't tend to acquire as much as US companies in Israel. And public markets, I don't even have to say, that's pretty clear. So if you have the choice, you're not going to go on any European exchange. You would go US, right? So I think companies exit, obviously it does happen, but it's usually more either a very sector-specific issue or a sector-specific decision, or it's a second-best option than what you would have ideally liked.
So this is the time to teach you the word that is called Jein in German, which is yes and no. So that's my reply to Gadi. I agree with you that we see less European VCs activity in Israel for now, in the rise. I disagree on the exit scenarios because a typical exit in Europe would be an M&A, and here you have two possibilities. One, you meet a European company which doesn't know how to innovate but simply expands through M&As, or the Americans who want to expand into Europe and need something that is already there and has a market share and a good product. So don't give up your hopes on exits in Europe. Again, we'll do QA in a minute. Okay, we're not doing comments, we're doing questions. So, questions. So anyway, but that's a good idea. Let's open the round to questions. Anyone with questions? question, not a comment.
How do you consider hardware-related startups and non-hardware-related, like you speak about fields and stage and a lot about this, but less about
In terms of
hardware.
valuation,
And hardware, and willing to invest in hardware-related deep tech?
Gadi, and then Boaz, you did hardware deals.
I think it's a very investor-specific question. So some investors like us, we would look at everything. So we have no aversion to hardware. We have no aversion to deep tech. On the contrary, and at the same time, we would also do data and software plays. So some investors would say, you know, I don't want anything that can fall on my leg and break it. So don't bring me any hardware investments. And admittedly, hardware is sometimes more difficult. It's more capital intensive. Usually it requires more time. Not necessarily that the exit multiples are better. In many cases, not as good. May, yeah. So it's a specific question to the issue itself. Some investors would have no problem, like us. Some would say, you know, I'd rather do something else.
Yeah.
So yeah, we are doing both. So we're doing both. Like Gadi, so Qualcomm Ventures has met many great hardware investments. We have companies across different stages. So like Innovium, and I mean there are many of them. Robotics, we did Verity, Anybotics. So we're not afraid of that. In general, multiples in hardware, we know they're lower. It takes more time to build the companies. It takes more time for the exits. And sometimes the reward, obviously sometimes is better, sometimes not. Obviously in AI and software, multiples are higher, gross margin and so forth. On the other hand, if you look today at AI and everything, especially in the app player, I think the moat is obviously becoming much, almost, hard to be defined. So to some extent, having a hardware software company is a good moat. For us specifically, the combination of hardware and software, that's the best. So if you're doing just hardware only, that's becoming even tougher. Not from technology perspective, from business perspective, but combining these two, that's creating a nice moat, especially today when the moat is becoming much harder, especially in AI layer.
Yeah, just to echo what.
Wait a second. I just want to get as much. We have 6 billion to distribute.
You hold the power,
in
Gili.
6 minutes.
Yeah, I wanted to ask regarding the differences between the motivation of CVC and venture capital. So what is your motivation for investment? Is it to buy the technology? Because like a big company like Porsche or whatever, what does it care about a small startup?
So recapping, is it about strategic investments or financial, correct? Yeah. So
happy to jump on it. So Porsche actually went through specifically a journey. We started very much a strategic fund, and we moved more to kind of a mix, moving towards more of a fund of a financial oriented fund. Usually, as an investor, when you're targeting only strategic endeavors or strategic interests, you might get yourself in a situation where you're leading around in a company that seems super strategic, but that company at the end of the day is startups. Startups tend to pivot, they move quickly, they shift quickly, they're dynamic. We as corporates are not dynamic in any sense. You might find yourselves in situations where after one round, and that's it, you'll figure out that the company pivoted outside of your strategic angle, and in that case, you might stop investing. And that could be a very bad indication. So I think that there is no wrong or right here, but I think that from, in the balance between fully strategic and fully financial, there is a sweet spot in between where you have a lot of know-how. We have a lot of know-how in the strategic angles of what's interesting for us. But on the flip side, if we don't look at it from a deal-by-deal perspective and from a financial interest, we might find ourselves after one round saying, okay, this is no longer strategic for us, so we're going to sit this one out. And nobody wants that. Not the corporate, as we're trying sometimes to show, okay, the way we invest makes sense, and also the startup that one of their investors on the cap table now after one investment or one round is no longer relevant or kind of stays quiet, kind of a dead capital on the cap table.
Other question, gentleman in the back. Can we have a mic there, please?
Can you hear me?
Roger.
Zaki is the name. I'm a global managing partner of investment bank called the GCA. And I was wondering your views with regards of non-funding model related to strategic alliances as a way to bring on board investment and collaboration.
Sorry, we didn't understand the question.
Again, non-funding investment vis-a-vis strategic alliances.
Now
What
we'll
would be
skip
your
this.
view?
These are all startup investors. Other question? No questions. Okay, so we'll continue. I have so many. Dean, safe or equity round?
Depends. I think
Safe or equity?
look, safe is good for bridge.
It's one word answer. Safe or equity?
Equity.
Was.
Equity.
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 Okay. Early or late stage? Gadi? Early or late stage?
In the middle.
I would say we would go earlier.
Early.
Objectively growth.
B2B or B2C?
B2B.
Was.
B2B.
Kill?
Yeah,
What they
same.
said. Where's the spirit of an... Okay. Hardware or software?
Unfortunately, having to do hardware prefer software.
Same.
Was.
Software.
Software.
AI or defense tech? That sector.
AI.
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 Cannot do defense tech, so
Same
AI.
same for me, so that's the only option I have, you know.
So,
You can say defense
so
tech, but you
food
cannot do
tech or
anything about that.
robotics? Food tech or robotics?
Robotics.
Robotics.
Again, we don't do food tech, so it's only one option, you know.
Deal.
Robotics.
Okay. Munich or Berlin?
You're getting me into troubles.
Say Hamburg.
Hamburg.
For me, Munich.
I'll answer for both of us. Go Stuttgart.
Okay. So between Zurich and Munich, Gadi. Tough one.
Munich, I think.
Yeah, Munich is on the rise. I think it's a hard battle, but I think Munich.
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 Okay. There's one last thing to give the startup on the audience on fundraising in Europe. Dean, one most important thing for, in your opinion, of course.
Gadi, why won't you start and I'll be last?
Okay, Gadi, start. One most important thing the audience should know and about fundraising from Europeans.
Be professional.
Yakir.
Know your business.
Boaz.
Don't oversell.
Bring an initial investment from Israel before, because the same way that it will be weird for us if suddenly a startup from Zurich will land in Tel Aviv and start fundraising from Israeli VC funds, that's the same logic for Europeans. So first of all, have your first success back home, and then bring the European investors as well.
Fair enough. Question, did anyone think? Yes, please. Mike is coming, all good.
Thank you. You already covered issues related to hardware and software, and you told already that you unfortunately need to invest maybe to hardware more, but prefer software. My question is, if the startup has another model, I'm talking about IP licensing, specifically question, for example, for Qualcomm Ventures. I mean hardware IP licensing. What is your mind? It's good for venture like Qualcomm?
Well, even though Qualcomm is making, I don't know, $5-6 billion per year for IP licensing, I don't recommend for startups to go with that business model. It's very hard. Collect this money I mean, we do it per device and there are billions of them, but in general, it's a very tough business. So I wouldn't recommend to go with licensing model for that.
May I continue?
I know our time is up. So thank you, dear panelists.